Dr. Amir Baluch, welcome back to Doctors Unbound.
Hey, how's it going? Glad to be back and burning the night oil with Doctors Unbound.
Yeah, for sure. For those that might see the video, I don't know if we're going to release the video or not, but you've got a pretty awesome Dallas skyline in the background there. So it's beautiful there at night. Looks like you've got a pretty sweet pad.
It's pretty cool. Sometimes the lights keep me up a little bit, but I stay up late anyway.
Yeah, you're one of those guys that is working all the time. It seems like.
Yeah, this is pretty late for you too. It's almost 11 p.m. here on a weekday. So
It is. It is. It's past my bedtime, but tonight has been a recording session. We've recorded a couple podcast episodes, getting some really exciting new material out there for the listeners, and so I'm excited to have you back on the show because we're going to talk about some stuff that I don't, at least I haven't seen talked that much about. And I listen to a lot of podcasts. So I'm excited to talk to you. We're going to talk about kind of the stock market, the publicly traded companies. There's been a lot of hype in the media because Uber just IPO'd and people are talking about Airbnb. That's going to be coming up soon. So there's a lot of hype about that. But I'm excited to talk to you about the stock market and kind of compare and contrast it to investing in privately held companies. So let's just dig right in. Let's start with the public companies. What are some of the advantages of investing in these public companies?
well, this is what everybody really thinks about when they think about investing in general. They're like, "Hey, let me invest in the stock market." In fact, probably 95% of people in their retirement accounts, they probably only have public stocks and mutual funds. And I think people are becoming a little bit wiser. They kind of know why. It's mainly because the custodians of their IRAs only get commission on these things.
Hmm.
And some other people, such as yourself, have now learned they can self-direct their IRAs and diversify even into private stocks. But because public stocks are so common and it's well known, I think that's why people it's almost like a lemming effect. They kind of jump into it thinking that's the only option. But that's also kind of one of the advantages, like there's easy access to it.
Right.
Easy. I mean, so you know anybody that has shares of Airbnb? It's a private company. It's not easy to get that, right? But if you want to get, Chipotle or Starbucks, you just click a button on the computer. So, but that's one of the advantages. You have easy access to it, so everybody can access it. And not only that, there's so much data on it from Morningstar, or even just do some Google searches on the company. You're going to see what you want to see. You can see price to earnings ratio. They come out with their quarterly earnings and everything. There's news constantly about whatever stocks you want to invest in. So that's another advantage of the publicly traded stocks. One thing that I think is the biggest advantage, and for me, like one of the only advantages, is that it's liquid. So
Right.
if you have liquid cash, you either put it in the bank or, to maintain that liquidity, what else can you do? There's not that many completely liquid investments where you just can push a button and boom, here comes the cash coming back into your account. So you can stay semi-liquid by investing in public stocks versus, a private stock like Airbnb. The employees that have shares of that, they're not going to see, they're really not going to be able to cash out till it goes public. And then even then they're limited to when they could cash out. There's usually a 6-month lockup. So you don't have those issues with public stocks. So
Yeah, I think that especially the liquidity is probably a big one for a lot of people, and like you mentioned, the ease. I think we have a problem sometimes in this country where people are just not saving and investing enough. So as compared to not saving anything, um, you know, having something available, I guess, is better than nothing. But in this podcast, we're about being unbound. So we're looking for those unbound returns, and we'll get into that probably a little bit later. But let's move on and talk about maybe some of the disadvantages that you've seen related to the publicly traded companies.
yeah, so a couple of the disadvantages, and I started off when I was like 17 or 18 investing in public stocks. I thought that's really the only way to go. and actually had two financial advisors that were friends of mine, and both of them managed actually separate accounts for me. And over a couple of drinks, they're like, we played this game where, they blindly picked some stocks, and they wanted to see if that would do any better or worse, than actually try to make some calculated decisions. And then they compared it to the S&P 500. And pretty much all the returns were within about 1% of each other. So it's kind of like, really, it's such an efficient system. It's really hard to gain a little bit of alpha, over what you would get if you just blindly invest in the S&P 500. So because it's so efficient, it's really hard to get a good risk reward ratio. That's one of the things I really don't like. Speaking of risk reward ratios, a few people on here probably know about price to earnings ratio. And for example, let's say a company is making $1 million. What is that company worth? Is it worth 3 million, 10 million? So therefore price to earnings ratio come into. With private companies, like let's say a business down the street probably trades like a 3x. That means whatever it makes during a year multiplied by 3, that's the value of the company. Right now, or in the 1980s, publicly traded stocks were trading at an 8x. I think around 2012, it was like a 14 or 15x. Right now, it's 2019 at the time of this recording. They're trading at, the S&P is trading around a 21x, and the Russell's trading at a 41 or 43x.
That's pretty high.
That is really crazy. So when you look at those numbers, I mean, what are you really paying for? I mean, you're getting pennies on your returns. Really, when you look at those valuations, I mean, it's really wild.
Let's back up and discuss that a little bit, and let's talk about privately held companies, because this is kind of interesting to me. So let's say you have got a private company. Maybe somebody's thinking about buying that entire company, and because we're talking about multiples here. How do these multiples work, and does it depend on the industry to kind of get an idea of the multiple? Because I look at a PE ratio, and honestly, for me, it doesn't tell me a whole lot.
Right. So, you know what? I talked to a couple M&A guys and investment bankers about this to really understand it. It took me a while to understand this also, but pretty much there's going to be a market price for a business that generates a certain amount of cash flow, and there are going to be certain variables they look at. So, for example, and the people are willing to pay more for that given cash flow, a higher multiple, if those stocks are perceived to be more stable. So it might be a bigger company. And I'll give you a healthcare example of that too, which everybody can relate to in a little bit. So if it's a more stable company, if it's extremely disruptive, for example, I'm part owner of an LED lighting company, and there's still like more than 90% of businesses that are not using LEDs. So market penetration is really low. So you have all this market to take over. So that gives high multiples. What else? Different industries can be considered disruptive. For example, software is really hot right now. So they're trading at sometimes 20x in the private world, depending on how disruptive it is. So it's kind of like how people are perceiving the risk reward, and that's how you get these multiples. Now it seems like, let's look at the doctor world. Most clinics will probably trade at like even a 1.5x, maybe to a 3x. So imagine you're a doctor in Dallas, Texas, primary care, whatever. You're making, for every $100,000 you're making, let's say you're making $200,000 net, you're going to sell your practice for maybe $400,000. That's probably what it's going to be. And the reason is, if somebody buys you out, the risk of those patients leaving when that doctor leaves is really high. Like the doctor was the business, sure. Right? So when you acquire that business, the risk is so high for the other person to get some attrition, and that's why it happens. But what are we seeing now? I'm sure you've talked to a lot of other doctors about this before, but you see how everybody's rolling up and buying out primary care doctors. They're becoming conglomerates. So what happens in the private sector world is, let's say you have a doctor making $500,000 to $1 million net. if there's something like that out there. Still trading it at 2-3x.
Mhm.
But what happens is when that entity starts netting, 30, 40, 50 million, or you have like 80, 100, 200 doctors under one umbrella, there's some efficiencies in the system, and that whole system is perceived to be more stabilized. Now you're looking at like an 8x, maybe a 9x, something like that. So that's the play these private companies are doing, because they feel that there's more stability in a conglomerate and some more efficiency, and that leads to higher demand and higher price.
And maybe they're negotiating higher rates since they've got more docs under their system.
Right. They're a bigger player in the game. So all that, they have a bigger influence on the market also. So all those things make it perceived to be a safer, more solid, secure company. You're going to pay higher for that versus a risky fly-by-night company. Who wants to pay a high multiple on that?
Sure. Okay. Let's move on to the to the private companies, and let's talk a little bit about that. What are some of the advantages that you see when somebody's able to invest in these private companies?
Well, for sure, the valuation. I mean, we're looking at 2, 3, 5x on the street. So I think I bought a med spa in 2013. I
Mm-hmm.
bought it at 2.5x. So imagine if I bought that all cash. Well, let's use rounder numbers. Let's say I bought it at 3x.
Okay.
If I bought that all cash, my return on investment, if that was a true system, nurses running the show, and I'm not doing anything, my return on my investment would be 33% without any leverage. If I leverage into it, you're looking at like 60, 70% return on your down payment, and 80% is probably coming from an SBA loan. So
Mm-hmm.
cash flow wise, I mean, public stock market can't touch those kind of returns. On the opposite end, I mean, if you're just a one and only med spa, you're not like some national franchise or something. There's a little bit more risk with it. But if you're somebody that can go in there and manage the risk, you can get those benefits with a little bit downplayed risk. So that's probably one of my favorite reasons for investing in private companies. Another thing is, I don't know if you do any insider trading, and it's kind of like people think,
Nope.
oh, hey, illegal, right? Well, see, actually, I do insider trading, but it's not illegal if you do it in the private world. even when I do real estate, it's kind of like insider trading, right? Because I know what the person might sell. Maybe they're going through a divorce or something like that. And in a private company, I can kind of get a feel for the market, see why somebody's selling, and see what factors are going on. And you can negotiate with them a lot easier too. I can't negotiate with Chipotle on their share price.
Okay, so let me just clarify a little bit. When you're saying insider trading, what you really mean is like really digging in to understand what the other side's needs are. Why are they selling? Why are they exiting?
Information, yeah.
Yeah.
Things that may not be made public, you can use that to decide on what you want to buy. But in the public stock world, you're not allowed to do that.
Right. And I haven't done it on the same level as you have, but even investing in, let's say I want to buy a property for Airbnb, as soon as I walk into a property, there's certain information that presents itself. Is the house empty, or is somebody living in there? And if it's empty, then you can just ask the realtor, say, hey, where's the owner? Oh, they've already moved out of state. Already now you're gathering information that you can use to negotiate. That owner probably is paying a mortgage on a property that is not being rented, that is just money coming out of their pocket every month. So you can already start gathering this information if you really know what to look for.
Right, exactly. Yeah, I remember you were telling me that person was out of state, which is huge deal on the negotiations. So
Right.
But you can do all that stuff in the private world. In the public world, there basically is no negotiations. Like what you see is what you get. You're going to pay top dollar, and that's it. So valuations, negotiations. Also, get a little bit of decreased volatility. So imagine if there's any news about anything on any company, if it's good or bad, you're going to see the stock price move like immediately. But really, that news might not really affect the actual fundamentals of a company. Like, is it really going to affect their earnings or not?
Right.
Usually not. So you have all this volatility, it's just like, it's not really good for your investments. Because even if you take like a short-term loss, like just to make the math easy, let's say, if the stock went down 50%, to get back up to break even, you got to double your return. So if it went down 50%, now you got 50 grand instead of 100. And if it went up 50%, you're still at 75. So even if it goes down 50 and then up 50, at a superficial level, you might be thinking, oh, I should be break even. But when you look into it, you're still down 25%. So that's how the volatility hurts you, unless you're a trader. Like if you're trading, you might want some volatility. But for the most part, people don't want volatility in their investments. Generally speaking, you don't want that. Like if you're a buy and hold guy, you probably don't need that volatility. And most people that I know, especially, if you look in these now physician Facebook forums, everybody's all talking about buy and hold index funds, right? Just invest in S&P or whatever. Like they don't need that volatility. So that's what's the benefit in the private world. You really don't have that type of volatility.
Well, and I think you came upon a great point, which is, investing, you really want to minimize your losses. And like you mentioned, if you lose 50% of your investment, to make it back up, your investment now has to double. It has to go to 100%, right? So like you were saying, once you lose 50%, you gain 50. You're not there yet. So that's a fair point. How about some disadvantages of investing in these private companies?
Well, we talked about how the public company is so easy to get. Just open up a trading account and click a mouse on your computer and you're done, right? But how are you going to get shares of Lyft before it goes IPO or Airbnb? It's not that easy. And then how are you going to do the due diligence? Like actually their accountant is going to have to mail you something. You probably have to hire an underwriter unless you could do it yourself. And, it's kind of a little bit of a headache. So there's a big barrier to entry to actually getting it done, which I actually like. That's what, that's where you can make that's how the reason you can make some money is if everybody had access to it, then, price would get bid up. But, the downside is it's just not easy to get in there. I was lucky enough to get actually some Airbnb shares from an employee through a broker in San Francisco. So, but that was just through a connection and the employee wanted to liquidate. So, but I mean, it's really hard to do otherwise. That's probably one of the biggest, that's one of the hardest things is access to a good private equity deal. And then even if you have access, how are you going to do the due diligence? Because there's not that much public data out there.
So let's follow that thread just a little bit further. Let's say you've somehow found this person who wants to sell for whatever reasons, they need the money, et cetera. And so now how do you do that? How does that negotiation work out? How do you settle on, the price per share or what have you? How does that all play out?
Okay, so that's a good question. So a couple different ways to value a company. One way is just you can just pay for somebody to do a third party appraisal, and that usually costs a lot of money. Usually starts at around $7,000 up to 6 figures depending on the company. But what they're going to take a look at is the financials, more than just 2-3 years, and the longer track record of financials you have, the more stable you feel that these financials are. Like it's more of a sure thing that these numbers are going to continue, right? So if a company has only been in existence for 1 year, hey, valuation on that same cash flow is going to be a little bit less, like a little bit lower multiple. But if if the company's been solid gains for 10 years, I mean, the chance of them going on for another 10 years is a lot higher, right? So you're going to pay a higher multiple because that risk has come down. It comes down to how you evaluate risk and reward. And then you want to also look at what type of systems they have. Like if you're going to acquire a company versus just passively investing, like how many things are systematized in it, where if you came in and acquired it, you don't have to do anything. Or you could also look at, hey, how disruptive is this and how much market share is left? How much market share can they take? Because you want to see them grow.
Sure.
So that's another way to do it. Some quicker ways to do it is you just say, hey, what was the last capital raise and what was the valuation then? Mm-hmm. Like if somebody just yesterday came in for $100 a share, hey, it's worth $100 a share, because the market spoke. Like it's almost like a comp. Like if somebody bought the house next to you for, $200,000, guess what? Your house, if it's around the same size and everything, is probably about $200,000.
Sure.
So that's another way that a lot of people do it if they don't spend the money on a third party appraisal.
Okay, yeah, thank you for explaining that. So now let's kind of think about how to put it all together. I do some index fund kind of stuff with my 401k. Like you mentioned earlier, I also have a self-directed IRA where I like to invest in some other types of funds, projects, things like that. It gives you a lot of flexibility to invest in stuff that's not stock market kind of stuff. But I'm still trying to figure out my philosophy and how to put it all together. So I'm wondering, how do you approach this? How do you look at all this?
Well, it's really about an individual's priorities, and that changes all the time. Even mine has changed from just wanting to grow a huge net worth to now I'm actually just care a lot about cash flow
Hmm.
and passive cash flow. So I've changed some of my asset allocation because of that. But one thing I do just to get kind of a standard is, who on the planet or in the United States has a lot of money to pay for consultants to help them for their portfolio. So I look at the way the Harvard and Yale endowments invest their money. Of course, their priorities are a little bit more about stability. They're not trying
Hmm.
to take a lot of risk. But if you look at how they allocate their assets, they have about 40% in real estate, about 15% plus or minus in public stocks, about 15 plus or minus in private stocks, about 15 percent, maybe 20% in cash. Everything else is kind of miscellaneous. Maybe they might be sitting on gold. Maybe they've invested in some life settlements, maybe some annuities.
I wonder if they'll get some crypto in there.
1% crypto is great. actually, that they are doing that. It's market's getting a little bit bullish now because these huge institutional buyers that want to get into crypto now as a hedge uh, against the economy possibly going down, the stock market going down. So that's just not happening right now. So that's how they do it. Another group called Tiger 21. There's a group of high net worth individuals where to get into the group you have to have a liquid net worth of 10 million. Well, their recommended portfolio looks almost exactly like Yale and Harvard's. So I'm not saying that's the best thing to do, but you see the trends when people have a lot of money, they're trying to protect it and what that portfolio looks like. If you're a young doctor and you're willing to take more risk, you could do other things, or maybe you could even keep the same asset allocation, but you might leverage more in real estate. Or hey, you might want to do more. If you're investing in private companies, maybe you want to be in the seed round and not in the Series B or C or something like that. So
I see.
within that asset allocation, you can decide where you want to come in and how you want to invest. But that it seems to be that allocation percentage wise seems to be somewhat stable throughout different groups of institutional type investors.
Okay, very, very interesting. Now, as you look at the rest of 2019 and kind of the immediate horizon, what excites you most in the investment space?
Well, I'm huge on real estate. I'm huge
Sure.
on
Yeah.
everybody and their dog is doing real estate now, and it's you know I think multifamily is oversubscribed. I mean, cap rates are really compressed right now. That might change later, but right now, like in the real estate world, I think Airbnb is really hot. It's an inefficient system. People don't know how to get in. There's a little bit of a learning curve, and that barrier to entry is making it worthwhile for people that know what they're doing. Same for on the real estate side. Again, same for real estate developments. Being a developer is probably the hardest thing you could do. It's a really huge barrier to entry. You got to have crazy relationships, 5-10 year long relationships. You're working with the city. Like you can't just go to a one weekend course and now you're a developer. It doesn't work. It takes years.
Hmm.
So I like that too, because it's not oversubscribed. It's just too hard to get to it. Then outside of the real estate world, I'm really loving tech right now. I mean, I'm into tech myself. I'm an end user of the tech. This is probably the first time you see me without my Bluetooth on.
That is
Right?
that is true. You've always
Which
got that
connects to
on.
my watch, which connects to my phone, which connects to my computer, which connects to everything else I got. I got all this electronic stuff going on. So I love my Sonos. I love my Google Nest thermostat. I just like that stuff. So I just like the efficiency in it. And guess what? In the tech world, they're trading at pretty high multiples right now. Because having tech, you can scale this stuff so easily. Because they're saving, either time or money, there's some efficiency gain. And so people are just going to adapt to it, and it grows really fast. So, Tesla, I like the tech behind Tesla. I have one of those too. That's what's really exciting me is tech. And then software is almost along the similar lines, like your software is solving problems in an efficient way. And so those things kind of resonate with me. And I really like where the future is going for tech and for software.
And what are the multiples on those types of things?
It's pretty crazy. Like, when it comes to technology, for example, let's look at the semiconductor technology, which is like LED lights. Mm-hmm. Just a few years ago, CREE was trading at 110x.
Wow.
110x. That's so crazy. But, company down the street could easily be trading for 20 or 40 right now. That's crazy. So, and software companies, they could be trading at 10x, not even on net revenue or EBITDA, but not even net revenue, just gross revenue. You have a company that's not even profitable and they're trading at a 10x of the gross revenue. So because it's so disruptive and people want it so badly and they see how it can scale and take over a whole industry, people want in on that. They're willing to pay a lot of money for it. So.
Okay. Well, awesome. Yeah. I think we're going to, get close to wrapping this up. I think it was really fascinating to kind of compare and contrast and think about, these different elements that are in the investment ecosystem that, most people don't really talk about or don't think about. So thank you for taking us through that. We'll just kind of wrap it up and kind of just see what you're up to. Like, any fun trips or any fun things that you've got planned over, the next couple months or so.
Actually, after toward the end of the month, I'll be going to Vegas with a bunch of my friends from Texas Tech. One of my friends turning 40, so we're kind of rounding up the troops and going to head out there for a weekend. My birthday's in July. I have like 4 or 5 days of vacation booked. I don't know where I'm going to go. I might go, maybe thinking like Canada or something out of the country.
Nice.
I only have 5 days, so I can't like go to China or something, but
I'm sure you'll find something interesting to do.
I'll figure out something. So.
Yeah, definitely. Well, you mentioned Texas Tech, and it just reminded me. My oldest is finishing up kindergarten, and the brainwashing's already begun because her teacher is a University of Texas alum, so she's learning the whole hook 'em horns thing, and then one of her other favorite teachers is a Texas Tech grad, and so she's showing me the guns all the time too. So I'm like, man, I'm never going to get this girl to USC because she's got the Texas Tech and the UT influence already.
Oh yeah, and they're getting them at a young age too. Yeah, so she's never going to California.
No, which who knows? Maybe that isn't so bad. Well, anyways, we're going to wrap this up. Amir, thank you so much for coming back on and dropping some knowledge. Really enjoyed talking and learning a little bit more about these different investment vehicles.
Always a pleasure, man. Fun time on the podcast for sure.